How to invest in China. Largest stocks and key risks. Hey there, future millionaire. Investing in China can offer the opportunity to find a highly attractive company growing in one of the world's fastest-growing economies. Despite the potential for finding a hidden gem and riding it to a gain, investing in China also has plenty of drawbacks that investors should be aware of. Before we begin, subscribe to our channel for more videos like this. How to invest in China. Step-by-step guide. Investing in China is like investing in American stocks in many respects. You'll need to find a broker, analyze the potential investments, including stocks and exchange-traded funds, ETFs, and then fund your investment. But it also poses some of its own challenges and watchpoints. 1. Choose your online broker. You can get started with an online stockbroker in a few minutes. The broker allows you to buy and sell stocks and other investments, while also holding those investments for you. It collects any dividends and interest paid by your investments. To open an account, you'll need to provide some basic personal and financial information, and then connect your bank account to transfer money. Most brokers don't charge any commission to trade stocks and ETFs, and many don't charge commissions for thousands of mutual funds either. Most brokers don't have a minimum account size, so you can literally get started with nothing. As you decide which broker makes sense for you, you could consider what features you need. If you're looking to trade Chinese stocks listed on an American exchange, then the best brokers for beginners will do nicely. These brokers are also useful if you want to buy exchange-traded funds, ETFs, that hold Chinese stocks. However, if you're looking to buy Chinese stocks directly on a Chinese exchange, then you should consider turning to Moomoo. This broker allows customers to trade Hong Kong stocks and China A shares, both of which are a rarity for an American exchange. The broker lets you trade American stocks and funds too, of course, and offers a number of other positives. Note: many Chinese stocks on American exchanges are typically in a legal form known as American Depository Receipts, ADR, or American Depository Shares, ADS. An ADR represents stock in the foreign country that is held by an American institution, which then issues the ADR to simplify the process of owning and trading the stock for American investors. An ADS is the actual share of the foreign company held by a depository institution and can be packaged into an ADR. Generally, the holder of an ADR can still vote in corporate elections and receive dividends. 2. Research and analyze stocks and funds. If you intend to buy individual stocks, you'll need to research them and figure out which ones are good investments. This process can require a lot of work if you want to make money. You'll need to research the company, its products, its competitive position, the industry, and the company's financial position. That means reading its filings with the Securities and Exchange Commission, SEC. In addition, you can use the top strategies of the experts, including your own research, such as getting out to local stores to see how the company's products are viewed. Chinese stocks that are listed on a major U.S. exchange must also make quarterly and annual filings with the SEC too, and they do so in English. That luxury may not be available if you trade stocks directly on a Chinese exchange, however. Chinese stocks present some unusual risks, so it's important to understand them. For example, many Chinese companies trading on U.S. exchanges have a complex ownership structure, using what are called variable interest entities, VIEs. This structure poses a significant risk to investors. More below. As of January 2024, 166 Chinese companies on major U.S. exchanges used the structure, and they account for 91% of the total market capitalization of Chinese firms on major exchanges, according to the U.S. China Economic and Security Review Commission. If you're looking to trade funds, you can screen for high-performing ETFs on your broker's site or using various online screeners. You should look for solid long-term performance and a low expense ratio so that you're not paying a lot in annual fees to the fund company. After researching the stock, you can decide whether it's an attractive investment or not. When you find a stock or fund that meets your criteria for buying, note its ticker symbol, typically a 3 or 4 symbol code. 3. Figure out how much to invest. It's time to decide how much to invest. If you're just beginning to make trades, it's important to know that you don't need a lot of money. Many brokers allow you to purchase fractional shares, and often you can purchase as little as $5 of a stock, regardless of its price. The best brokers for fractional shares let you buy thousands of stocks and funds with pocket change. But regardless of how much you purchase right now, you'll build wealth over time by continuing to invest regularly. So figure out how much you can invest now and then how much you can invest over time. By adding to your investments over a longer time horizon, You'll use the power of dollar-cost averaging to spread out your buying over time and reduce your risk. If you're investing a few $1,000s or more, you should consider investing in multiple stocks so you're diversifying your investments and reducing your risk. However, funds typically hold dozens of investments, so they have some natural diversification, and you may not need to purchase additional funds if you're satisfied with one. 4. Place your trade. You have your stock or fund picked out, and there's money sitting in your brokerage account, so it's time to place your trade. Using the ticker symbol, enter the order with your broker. You can specify which kind of order you want to place, a market order or a limit order. Market order. This order lets you trade shares for the best available price at the moment. You send the order, whatever it is. So you won't have full control over the price you buy or sell. Limit order. This order lets you name your price, and you'll only trade at that price or better. If you can't get your price, the trade won't be executed. Market orders are fine when you're trading just a few shares of stock or the stock is larger and trades millions of shares a day. Limit orders are better for small stocks or when you're putting in an order for hundreds of shares or more. In short, use a limit order if you think your purchase or sale of stock will move the stock price significantly. Once your buy order is executed and settled, you own the stock. 5. Track your stock. Once you've purchased your stock, your journey has just begun. You'll need to continue to track the company, looking at quarterly and annual earnings, while also following what's going on in the industry. As the company's results improve, you can add more shares to your position, and later you can add more stocks or funds to your portfolio as your expertise improves. Your stock may decline for any number of reasons, but that's just part of investing. It could be a good time to buy more stock in the company, or it may not be. If you're tracking the company, your knowledge can help you decide whether it's time to buy more or even time to sell. If you don't want to do the legwork required to invest in individual stocks, consider buying a fund that invests in Chinese stocks. More below. Index funds may own dozens of stocks, and your return depends on the weighted average performance of the entire portfolio. You'll get the benefit of diversification and won't need to do all the research you'd need for individual stocks. Risks of investing in China. Investing in Chinese stocks comes with some significant risks, so investors will really want to pay attention to the following. Government intervention. The threat of government intervention into business is quite real, and the government and regulators may tell successful companies that they need to operate differently or otherwise risk significant penalties. It's even possible that firms may be forced to pay special one-time taxes or other penalties. Murky ownership structures. Investors in Chinese companies need to pay attention to the corporate ownership structure, especially what are known as variable interest entities. A VIE may receive economic benefits from a Chinese company without actually owning the shares of that company, since Chinese regulations may prevent direct ownership of various companies. VIEs are typically registered offshore, often in the Cayman Islands, and the entity trading in the U.S. does not hold a direct interest in the Chinese company, only the offshore vehicle. Investors should be careful to understand exactly what they own, because it may not be as rock-solid as they think. Geopolitical. Geopolitical concerns can be significant, including the possibility of China gaining control of Taiwan and the global response to that event. Accounting transparency. Accounting rules may not be as transparent as American investors are used to. For example, for nearly a decade to 2022, the Chinese government stopped domestic auditors from complying with U.S. regulations on audit inspections, according to the U.S.-China Economic and Security Review Commission. Currency risks. Investing in a company that earns its profits primarily in another currency exposes investors to currency risk. If currencies move unfavorably, it could severely impair the profitability of the company in dollar terms and thus its stock price. Of course, these risks are just the specific one related to China, and investors must consider the range of other risks as they would with any investment. They should consider the company's competitive position, financial strength, management, and many other factors. Bottom line. China offers the potential for finding attractive investments, but American investors should pay careful attention to the risks involved when investing in Chinese stocks. These risks can be significant and can even affect investments that have fundamentally strong operations, solid growth, and robust finances. Thanks for watching.